Welcome, everyone. My name is Michael Johnson, and welcome to our Financial Literacy Month. My name is Michael Johnson, and I am the broker, owner of Realty Executives. I'm also a lender, and I'm just super excited to bring on Stephanie Hicks, who is the best in the business when it comes to financial literacy. She's been in the business for a while. She is a broker, and she is a owner of World Financial Group, and she just is a wealth of knowledge. So I don't want to steal any of her thunder. So what I'm going to do, without further ado, I'm going to turn it over to Ms. Stephanie Hicks. Stephanie, introduce yourself, kind of give us a little bit of background, then let's jump right into it. So everybody put your hands together for Ms. Stephanie Hicks. Oh yes, if anybody wants to ask any questions, please use the chat box if you can. If you cannot, just come on, unmute yourself, come online and ask away. I will be helping Stephanie to monitor the chat box. So I really appreciate everybody being here. And now, without further ado, Ms. Stephanie Hicks.
All right, thank you, Michael. Hey, I want to welcome each and every one of you guys for taking time out of your busy schedule, to join us this Saturday morning. As Michael said, my name is Stephanie Hicks. I'm married to the awesome Tony Hicks, and my husband and I, we've actually been married for going on 31 years now, you guys. And he was the one that was actually introduced to the financial service industry, nearly 30 years ago, right after we had gotten married, because we'd gotten out of college and we simply wanted to make sure that as we started our family, that we were doing, the best that we could. We were just doing, whatever it was that we could to make sure that we didn't repeat some of the patterns that our parents had repeated and our grandparents had actually repeated. And so usually it takes time, in order to, for folks to be able to break, some of the, the cycles of what it is that they've actually seen, in their family. And so I'm super excited about, for my husband, and thankful to God, the Most High, for him, because he had vision for our family. And, we have two sons, and, they're young adults, and we've already put them on a path, to financial literacy. I'm one of the investment advisor reps, with one of the companies that have been around for over a century. Started off as, Bank of America way back when, and transitioned into Transamerica Financial Advisors. So, so I'm actually one of the investment advisor reps, and I'm licensed in about 18 different states. We move and market products and services through, the marketing company, World Financial Group. And so, that's a little bit about me. My husband's also an investment advisor, and that's actually how I ended up getting to the industry. I will share this, for anyone that especially wants to become financial literate and learn about money, definitely take some notes. My husband had 2 strokes back in 2009. And one of the things that was extremely comforting, for us, there was 2 things that was comforting for us. Is one, that he knows the Lord, so he wasn't afraid, if he had passed or something or another like that, because literally what he shared with me, on his bed of affliction was that, if anything happens to me, then I'm good because I know where I'm going. He said, but in addition to that, you and the boys are going to be good as well, because I put things in place for you. And so you guys, that was, as a wife and a mom, that's extremely comforting. I just wanted the Lord to heal my husband, so that was extremely comforting, because just knowing that, God forbid, if something were to happen to him, and he's doing well by now, those that see him, he's a walking miracle. So he's doing well, but just knowing that if anything had happened to him, and then, that me and my family would be taken care of, we wouldn't have to relocate to other homes or be homeless on the streets, and still the kids would still be able to go to college, and do to and still be able to live the lifestyle that I'm used to. So let's not take anything for granted. The month of April is Financial Literacy Month. I'm going to go over a couple of concepts that it is that you guys need to know, and you'll have an opportunity to be able to get with myself. But then also Michael is the real estate guru. Michael's the real estate guru. And so, whether you're near or far, he's actually able to make sure that, that you're connected with the right individuals, you're local, to be able to, help put you into the right situation, whether you're a homeowner or renter or whatever, it doesn't matter. He's actually able to help you out. So, so I really appreciate and am thankful for the relationship that I actually have with Michael. And I thank Michael for putting on, this event as well. So you guys, we're going to go ahead and get into it, and make sure that if you do have some questions, I'll be having my information so that if you don't get your questions answered here, it seems like I went over some things pretty quickly, that's okay, because you're talking about a lot of times, 20, 30, 40 years of you listening to someone else, your boss, the job or something, or, another. And then here we come bring you, a different spin on some stuff, but it's a spin that works. It works for the wealthy. And we simply are here to kind of teach you what the wealthy do. So let's get at it. What is financial literacy? It's a confident understanding of concepts that include savings, investment, and debt that leads to an overall sense for the individual, that they're okay, that they're going to be good. But a lot of times, you guys, it actually starts with basic building blocks of knowledge of money matters and the various vehicles. You will hear me call them vehicles. What is a vehicle? Something like a savings account or a checking account is what most people are familiar with as a vehicle. But the different type of various vehicles that are used for financial well-being. And it just so happens, that, just checking a savings account is not enough. It's just not enough. Okay. So a couple of topics that we're going to cover is how money works, also financial independence. What is it? And what are the ways to actually be able to get there? Okay. And then we're going to dig, we're going to gloss over family banking strategy. What would the Rockefellers do? People talk about, hey, they like to be financially independent. They like to be well off and everything. This is the question. Do you even know anyone that's in that position? Who's training you? Who's teaching you? Where are you getting your information from? And one of the biggest things that I found that I've been blessed with my husband and I in our business is that, Napoleon Hill says, if you want to be a millionaire, find one and do what he or she has done. Find one and do what he or she, and it just so happens to be with my company in my, in my arena. I got tons of them. My husband and I have had an opportunity to, where we're being mentored by a billionaire. No, we're not there yet. The thing of it is, but we're being mentored by one. So you find someone that's where you want to be, and then you follow them. One of the things I don't do is quote unquote take advice from people that make money actively, that simply have to get up and go to work every day for money. I don't take advice necessarily from those folks because they can only tell me how to get up and go to work every day. They can't tell me how to position myself to make money work for me. And so how does money work? There's a concept called the rule of 72. And you guys will hear this concept, throughout this month. You will hear this again. So the rule of 72 simply says you take the number 72 and divide it by whatever rate of return you're receiving on your money. That's your money making money for you. And that will simply let you know how quickly your money is going to double. So let's say, for instance, on the far left corner, I'm getting a 4% annual rate of return. 72 divided by that 4% annual rate of return says my money's going to double every 18 years. If I start off at age 29 and I had $10,000 and I did not add anything to it and I didn't pull any loans from it or anything like that, 18 years, age 47, it turns to 20 grand. And then age 65, it turns to 40 grand. But what if I'm able to, on the right side, be able to get a 12% rate of return? Well, that's 72 divided by 12 says my money's going to double every 6 years, okay, as opposed to every 18 years. I have a whole lot more doubling periods. And so that actually gets me up to $640,000 versus versus $40,000. So at the same age over here at the 4% versus the 12%. But this is the kicker, you guys. Do you know where to get 12% rate of return? The banks do. They know how to charge you credit cards, 25, 29.99% rate of return, 15% rate of return, 10% rate of return, so the banks and other entities, the payday loan people, oh, 500% rate of return. Okay. Some auto dealers, if you go to an auto dealership and you don't have the best of credit, then they're charging you 12, 15% rate of return. And I see it all the time because I'm doing analysis for individuals. So most consumers don't know where they can get those type of rate of returns, but the banks are getting it all the time. But this is what's happening, you guys. The banks are getting that 12%, if not more. They're getting the 640, but then they'll turn right around and pay you the 4%. But guess what? I forgot to tell you, you're not even getting 4% in your checking or savings account. You're getting something significantly less. And so that significantly less, they're keeping the difference because they are getting the 12 plus. It's how that works out. So the thing of it is that you want to position yourself so that you can do the same exact thing. Okay. Power of time. If I wanted to reach $1 million account and I have 40 years because I'm going to go to the job for the next 40 years, well, all I have to do is save $286.45 a month. For the next 40 years, I'll retire at an 8% compounded rate of return because we just talked about the rule of 72, the power of compound interest, and I'll retire, in 40 years with $1 million. But most people don't plan like that. They don't start planning until you see over here on the right where they hit 10 years. Oh, in 10 years, I'll retire. In 15 years, I'll retire. Well, it's not $286. Now it's $2,889 with 15 years left to go, that I need to be setting aside. Well, I can't do that because I got the mortgage, the house payment, car payments and things of that nature. There's no way I can set aside $2,889. I'm barely making that. That's why there's also passive opportunities out there in order for you to be able to make that type of income. So the power of time is money. So you want to be able to take advantage of that. Financial independence, because time is money, financial independence. What is it? What are some of the ways to actually be able to get there? So financial independence is the status of making sure that you have enough income or wealth sufficient to be able to pay one person's living expenses for the rest of that person's life without them having to get up and go to work or be dependent on other people. Okay. Now, financial independence for you could also mean living without debt. So you got money coming in. It could be coming in from a job, but you're living and you're debt free and you actually have enough income that can easily cover your monthly expenses. So it's a couple of ways, of how people consider themselves to be financially independent. Whichever one works best for you is fine because it's really, about making sure that, mentally you're not stressed out. You and husband or the wife are not fighting over the money. The kids are fine. You're not going to be put out of your residence. You're not, on the streets or things like that. And when gas prices go up, you're not really fazed about it. Yes, it's a reality, but you're not really fazed about it. Why? Because you're financially independent. The only people that complain about gas prices and everything are those that are struggling to be able to, achieve those things. But I promise you, I know several people with Bentleys. I'm in those circles and stuff like that. They pull up at the pump. It's like, it is what it is, whatever, is how that works out. The question becomes, how do you position yourself to be able to be that way? Well, there's a couple of ways to be able to get that. And Michael is doing a fantastic job. Real estate, you guys. This guy knows it, backwards and forwards pretty much, and so real estate is one of the top ways for you to be able to become financially independent. As I was working my way up through the brokerage, the real estate brokerage and everything, my days of doing that, one of my company's motto is God ain't making no more land, so you better get all you can. So I definitely suggest that you make sure that you get with Mr. Johnson. If you have any aspirations of owning real estate, renting properties out, leasing properties out, being able to get into commercial property, things like that. Want to make sure that that you're touching base with some folks that already know what it is that they're doing. But then number two is investments. that's my industry, investments, financial services, and you'll actually see here, in a little bit, some of the areas that we're actually able to tackle. Technology is huge. A lot of people are becoming financially independent through technology. One of the other ways are major, if you got a major talent, like if you can sing, dance, or you're in sports, you play baseball, basketball, football, or something like that, and you're making money that way. Of course, those are ways for financial independence as well. Although I know too many of those guys as well that make a lot of money, didn't learn what to do with it, and no, their agent aren't the gurus to be able to tell them exactly how to be able to make their money last for them. They're just not. We do a better job of those things. But then also media and health. So these are a couple of industries that people are actually able to become financially independent. But now when you talk about financial independent, you got to have the right habits to be able to get you there. Okay, the very first one, you guys, the very first one is visualize it first and then plan it. Visualize it first, then plan it. Then you got to make sure you're budgeting, spend less than what you earn, building smarter safety nets, being able to eliminate debt that's having more income coming in so that you can get rid of the debt, so that now you can really, simultaneously save like you really want to. Consider increasing your income if you're in the job market, and that's where you're sold out for being, because some people love a job. Some people like other people telling them what to do, potty break, pee break, lunch break, things of that nature, smoke breaks or what have you, and so that's fine for some individuals. There are other individuals where they're not cool with that. So when it comes to, increasing your income, you may want to go get another piece of paper, another degree, and be able to try and get, an extra $10 or $20 or something like that an hour, for a raise, but the main thing of it is eliminate debt, downsize to eliminate debt if you have to, invest frugally if you're really serious about it, and then buy income generating assets. Those are things that put money in your pocket. Automobiles, by the way, time you drive them off of the lot, they take money out of your pocket. Hate to tell it to you, but they take money out. So you want to buy income generating assets, things that, when you buy it, it puts money into your pocket. And then always kind of know where you are financially, because financial independence is diligence and sacrifice. It's going to take some of that. You're not going to get there overnight. So now here's an example right here, a quick example of a financial independence number. One of the first things that you need to do is, what am I comfortable living off of, annually a year? How much income would I really like to have, to be able to come in each and every year? Well, in this example right here, I'm just using $100,000. That may be your number, may not be your number. You come up with your number, but I am going to show this, way to be able to get to your financial independence number so that you can start working towards that. And we'll actually be able to, get you, complimentary analysis to be able to help you understand which vehicles you need to put your money in, or have that working for you as well. But $100,000 passive income, you take that 100,000 and divide it by whatever rate of return your money could be working for you. In this case, I'm using a 6% annual percentage yield. Okay, then that means your financial independence number is $1.66.667 million. So 1.67 million. Okay, is pretty much what that rounds up to. But this is the thing. How can I make that money last for me? Because $1 million is not necessarily a whole lot of money, you guys. It's not. How do I make it last for me? Well, what that means is I can be financially independent if I put $1 million off an account that was going to pay me a 6% annual yield every year. What that means is at every January 1st, time the bank's open, because they're not open on New Year. So January 2nd, I'll go and pull my $100,000 off, because I'm living off of the interest, and the principal is intact where it can continue to grow. And I simply want to make sure I'm putting it in the right vehicles where it can grow even faster than that. But this is the problem, you guys. Most people will rarely be able to amass $1 million so that they can actually be able to live off of it. Why? Because over here in this E quadrant, the employee quadrant, where 100% of the income comes from you. You have no leverage, and you're trading time for dollars. You're trading time for dollars. Then, the S quadrant for that individual that's self-employed, that's the doctor, the lawyer, that's the accountant, someone that's in, a field like that, where you own a job, and yeah, you make a little bit more money than the average bear, but you're still by and large trading time for for dollars. But over here in the business owner quadrant, the B in the top upper right hand corner, you want to own a system where the people actually work for you in everything, because you're leveraging the people. That gives you even more money. And what do you do with that even more money that you're doing? You're investing it in the, in the lower right column, where that money, you're taking money and it's making you more money. That's passive income. And that income is not depending on your presence of having to be there, you having to take care of anyone, anything like that. It's just income that's coming in. And so most people have linear income versus residual income. Their linear income is, pretty much based off of, them being an employee or, self-employed, versus being a business owner that owns a system, and then also being able to invest their money so that their money can grow for them. So now, what are some of the places that you can invest? Well, most people are kind of familiar with some of the, the regular standard places and everything. But for this segment, I just want to make mention of what it is that the Rockefellers would do. We'll actually get a chance to, delve into them a little bit further and everything. But here, I just wanted to be able to put up some numbers right here. Let's say, for instance, you're in your company's retirement plan. You were in that retirement plan back in 2001. This is before the recession hit you guys and everything of 2008. So you're in your company's retirement plan and you had $100,000 sitting off in that plan. But we got the tax-free banking strategy over here, which is what the Rockefellers do, or in something extremely similar to what it is that they do. So in your company's retirement plan, the market tank, those are your investments inside your company's 401k, 403b, your pension plan, your TSP plan, your Horizons plan, whatever it is that your company is offering as far as 401k, that it's tied in with the market. The market is guaranteed to go up, and it's also guaranteed to go down. Hear me clearly. The market's guaranteed to go up, but it's guaranteed to go down. And you'll see that here in this chart, where 2001, these are actual market returns, because this is past history. And anything that we discuss, just keep in mind, future performance is no guarantee of past history. But, looking at the past gives you a really good idea of what can potentially happen in the future. So back in 2001, if I had $100,000 sitting off in my company's 401k, and the market tanked that year, which it did, a negative 10%. Then now my account is down to 89,470. In year 2002, it tanked an additional negative 23%. Now my account is down to 68%. Most people think, oh, well, when I get that positive 26% in 2003, I'm going to be back up to break even. I'll have my $100,000 back. No, not true. It's actually, I'm only back up to $86,000. That's because if I take, a 10% loss, it's an 11% gain just to get me back all of my dollars. I haven't made any money. All I simply did was get back to break even. And guess what? That takes time. And remember, as we showed in a power time chart, time is money. So here you'll see that I had 100,000, starting off in 2001. It was back to 2006, you guys, 2006 before I crossed back over $100,000 again. So what has my money been doing that time? Losing. The market's been going up and down, which is what it's going to do. Okay. But then 2008 happened. And now my 100,000 it gained money up to 114, then went all the way back down to 70,000. I can't win for losing. Seems like I can't get ahead. It's called life. But the only thing of it is you got to know what the wealthy do. So even though you might not have the dollars that the wealthy have, you want to learn the concepts and do what they do. And you want to utilize these very same vehicles of what they use in order to actually be able to do that. So you'll see here, after the ups and downs in the market, 2020, I ended up, my $100,000 ends up with 292. Well, guess what? It's my company's retirement plan. So I still got to pay taxes. So let's say, for instance, hypothetically, I'm at the 30% tax rate. Well, that leaves me with about $204,000 to be able to live off of for retirement. Well, that's a bummer, because I know I can blow through that. And this is literally what most people are doing, you guys. However, what are the Rockefellers doing? There's things that are in place. There's vehicles that are in place that same $100,000, if I were to utilize that and not add anything to it, because the wealthy, they actually add to theirs. They don't just put it in and, just leave it. But in both of these cases, nothing is being added to it to be able to make it be even, Steven. And so I'm looking at an account, family bank type of account, where I'm actually 2001. Well, I'm indexing. where I'm able to get gains, but I never take losses. I'm able to get the gains of the market, but I'm never take losses. You'll see in year 2001 and 2002, my floor, my bottom line is 0.75. It's not even zero, and it's not negative 10.53. My floor is 0.75. Okay, which means that even when the market tanked, I made money. Now, this is, by the way, the situation that my husband and I are in, and that when 2008 happened, we were making money while everyone else was losing. Well, it's not that we were making a gang of money, we just weren't losing. Is how that, and that's helpful too. And you'll see why in a minute. Okay. 2002 happened. I made money there. Okay. And compared to my company's retirement account, where in 2002, I'm at 68,000, 2002 over here in my Rockefeller type account, I'm at $101,000. Okay. Then let's fast forward to 2008. Negative 38% over here in my company's retirement plan, but over here in my Rockefeller type plan, hey, the market tanked big time. I still made money, 0.75%, which is way more than what the banks are paying right now. But I'm at 155,000, double what it is I would actually have over here. And then here, 20 years later, as opposed to the 292, I'm at 498. But I'm also in a type of account where, I don't have to worry about paying taxes, because I paid taxes on these seed dollars, but I didn't have to pay taxes on this money as it grew, unlike my company's retirement plan. But there's one key thing I want to point out to you guys. One key thing, one very key thing that's very powerful. $292,000, you guys, in my company's retirement plan. But when did I reach $292,000 or thereabouts over here in my Rockefeller type plan, my family bank? When did I reach that? I reached that level in 2014, not in 2020. So what does that mean? That means that I have an opportunity over here to retire 6 years earlier from my job if I wanted to. I have an opportunity, and the sooner I get started, the better, but I have an opportunity to retire 6 years earlier if I wanted to, or I could keep working and then I'll have the 498 versus the 292. But the thing of it is it's my choice. Over here, I'm just hoping, I'm working and I can't retire. My retirement plan is on a hope and a prayer, hoping and praying that the market don't tank, just what it did in 2008 when many people were getting ready to retire. We're talking people that had $500,000 accounts that went down to $60,000. You're not going anywhere. You're simply going to be working for the rest of your life. And that's real. That's exactly what happened. Okay. So again, what would the Rockefellers do? You might not be able to start out with $100,000 in the account. You might be able to start off with $500 a month where you're committed to saving for yourself. You might be, looking to start off with that 500 where you're committed to saving for yourself. So you'll save for yourself $500 and we'll put that off into, a plan again that allow you to be able to get gains, but not take any losses. Do have to qualify for this plan. So again, we'll give you an opportunity to reach out to me and everything and see if you actually qualify. But in this case here, hey, first 5 years, I was doing $500 a month, and then I got raises on my job. So I started doing $550 for the next 5 years. And then the additional 5 years, 600. Then I moved that up to 650 a month, and then finally moved it up to 700 to the tune of, after about me saving for about 35 years, I saved 264 grand. But guess what, you guys? What am I actually able to pull out of this type of account? What am I actually able to pull out of this type of account? Well, if I'm able to pull out $54,000 a year, able to pull out $54,000 a year, and I'm able to pull that out, for nearly 20 years, I would have pulled out $1 million, a little bit over $1 million from my account. But guess what? I only put 264 in. That's the power of time. That's the power of compound interest. And then on top of that, I'm actually still able to leave some death benefit and everything for my heirs. So here I put in 264 and over 34 years, I'm pulling out 54 grand tax-free. Don't have to pay a dime in taxes on the money. And I'm able to pull that out for the next 20 years. You guys, what if I not only had one account where I was funding it that way, as I started getting raises and having multiple streams of income, I had a second account where I was doing the same exact thing. Now, not only is this account 54,000, I could have another account if I qualify for it, where that was paying 54,000 too. That way, by the time 35 years is up, now I got 100,000, but I got those streams of income coming in from different types of account. We can structure something specifically for your situation and everything, you know. And so private pension, same chart over here, but again, what are the Rockefellers doing? If you have funds sitting off in, you know, CDs and money markets and stuff like that, versus sitting them off into the market or brokerage accounts where it is going up and down, you can actually take those brokerage accounts and those CDs, you can sit it over into a private pension plan. Oftentimes we'll actually be able to give you a 25% bonus on your money just for moving it, and then also allow it to be able to do some of the same index situations and everything where you're able to get gains but not take any losses. Again, after that 20 years, you'll see in my company's retirement plan on my brokerage account, 585,000, but over here, $806,000. You guys, the key is not how much money you make, because some of you guys on here, you do very well. You make very good money. The problem is what are you doing with it? And how are you able to keep all of your chips? That's the problem right there. And so that's what you want to make sure, you know, that you're doing. And so a lot of people's way is very blurry. Confusing, is blurry, and they just can't oftentimes find their way when it comes to finances. Marriages are wrecked, the lines are blurred, usually because of money.
Excuse me, Stephanie.
Yes.
I have a question.
Yes.
Well, William Borders has a question, and I wanted to get it out the way because I think it has something to do with what you were talking about. William asked, can you experience losses with a IUL? And I'm not sure what an IUL is, but I'm sure you do, you know about it. So if you can answer that question for me, please.
Short answer is no.
Okay. Can you explain to the audience that may not know what is an IUL?
Yeah, an IUL is what's called an Index Universal Life. And that's actually a policy that you can actually qualify for. It's a life product that you can actually qualify. The wealthy don't sit their monies off into 401ks and 403bs and pensions. They put their monies there. Although most people are not wealthy, we show them how to actually get started with what they're actually able to do inside of their budget and be able to build from there. But it's an Index Universal Life. It's a building block of a coverage, life coverage that the wealthy have a ton of it, by the way. Interestingly enough, most people don't know it, the banks have a ton of life coverage as well. That's the reason why they're paying you 4% and they're receiving 12%. So.
Got it. Thank you.
Okay. All right. So you guys, most people's way is very blurry. It's very blurry and everything, and financial needs analysis. So we want to provide one of those to be able to, first things first, let's help you improve your cash flow. If you need to be able to earn additional income, we have ways to be able to make that happen for you, help you be able to create an emergency fund. I think with COVID, the pandemic, most people, you hear the pundits on TV talk about 3 to 6 months. You need about 12 months. Well, Stephanie, how do I have my whole annual salary set aside as an emergency fund? We need to help you improve your cash flow where you're not trading time for dollars, because trying to trade time for dollars, you're not going to get there. But to be able to have passive income, you will be able to get there and be able to make that happen so that when you have an emergency, the car breaks down or the house springs a leak or something like that, you have the funds to be able to do that. And we help you build that up. Asset accumulation, you gotta outpace inflation, and you have to be able to minimize taxation. We show you how to do those as well. Debt management, you want to consolidate debt, but once you consolidate, you want to eliminate it altogether. One of the things that most people ask, one of the questions that most people ask, hey, can you get rid of school loans? The federal ones? No, cannot. We're not in a position to actually be able to do that. Private ones, yes. Federal ones, no. They're not allowing you to file bankruptcy just to be able to get rid of those things. But debt, we can help you out with that. So getting rid of debt, consolidating it, freeing up dollars allows you to actually be able to save for yourself. Okay. Proper protection, you want to be able to protect against the loss of income. That's one of the things that my husband was talking about when he had those 2 strokes, and he was thinking he may not make it. He made sure that the income that he had coming in annually, I would be receiving that income. Okay, so that I could pay the bills. We're 2 family, we're 2 income families. So, you want to make sure that you're protecting your family with that. And then, of course, estate preservation, you guys, that's simply making sure that you put the right documents in place so that Uncle Sam does not get what you intended to leave for your loved ones. You got to put the right documents in place. If you don't have those documents in place, again, these are areas that we actually tackle right here. So, most people, even if you already have an advisor that you're working with, that's okay. That's great. We're simply here to give you a complimentary second opinion. We'll put together one of those and make sure that you don't have any holes in your boat. I've been doing this for a long time, been in the industry for quite a few years and everything. I have yet to come across, anyone, probably about 2 people, or I would say probably about 2 or 3 people that are fairly wealthy that pretty much have, for what they were trying to accomplish, pretty much had no holes in their boat. But usually all of us have holes in our boats in some form or fashion. And we need to make it be where it's not blurry. We need to make sure where we bring stuff to the forefront where it's actually clear. And so I think with that being said, Michael, we can go ahead and open up, for any additional questions, that folks might actually have out there. We want to make sure that we get their questions answered. Okay.
Absolutely. Stephanie, that was mind-blowing. That was awesome. I really, really appreciate you coming on board. It is now time for questions and answers. And if any of you have any question whatsoever, is now the time. Do not be concerned about what your question is, because I guarantee you someone else is thinking the same thing. Okay, so we want to make sure that we answer all the questions that we have. So I'm going to start it off because I have some questions. What was interesting was your explanation of how people make money. Some people are employed, self-employed. They adopt a system, and people's money work for themselves. What type of business can you say can offer a residual income if people get into it? What would you say?
Well, actually, Michael, there's a ton of businesses out there, but since COVID, a lot of people are actually masquerading. So you always have to make sure that that you're getting with someone that's legitimate. But I put up about 6 different industries, where you can go in and do some things, and then also be able to have passive income coming from what we call mailbox money. But in all honesty, you're in real estate, I'm in financial services. Those are the top 2. So if I were looking to make some passive income, I'd be trying to talk to you, or someone should be trying to talk to me, to get a better understanding of what we can do, and if there's opportunities for them to be able to make, a passive income in our industries, in the industries in which it is that we're in. And we do have them. We do have ways for them to actually be able to make, passive income. I know that you have a way for folks to be able to make passive income with you. And of course, I also have, in financial services, we have a way for individuals to be able to make passive income, with us, as well.
Okay, awesome. Gloria would like to know, how old is too old to begin building assets? I love that question, Gloria. That was one of the questions I was going to ask. You took it right out of my mouth. Let's ask it again. How old is too old to begin building assets? I just started working at 37. Is there a plan for me?
You're never too old, because one of the things that we actually do, and when I say that, I'm not just saying it just to be saying it. One of the things that we actually do at our firm is we help people to build and then protect wealth. So build it and then also show them how to protect it. No other firm does what we do. No other firm, all the other firms that are out there on the market and everything, they're not about building you, helping you build and protect. That's not even their mission. It's not even their mission. So in our particular case, like 18 to 80. And if you're past 80 and you have an estate and we need to work with you to protect it. And then, we have products and services that can do that as well. 18 to be able to enter into a contract, and the older you are, and then there's just additional ways and additional vehicles out there that actually will be able to help you still be able to get growth on your monies, but also ways for you to be able to protect your money as well. So Gloria, there's a whole lot of hope out there for you. Just make sure, you guys are reaching out, to me, to be able to actually make that happen. But you got plenty of time, and always, you guys, for each and every one, the time is now. There's always, because I did show you in the power of time chart, the longer you wait, the more it's going to take. It's going to be a little bit more arduous. The task is going to be a little bit more arduous at that time. But if you get started sooner rather than later, now you have time working in your favor. And that's exactly what you want. You want to have time working in your favor, with that. Okay.
That's awesome.
Yeah.
I also want to throw this in as well. In order to get the money you need, in order to invest properly, sometimes you just have to work very hard and be very disciplined. But I do want to say this, there is a ton of businesses out there that you can do on a part-time basis that will help you to create residual income. One of those things is Stephanie. She's always looking for insurance people to work with her. And I understand that that's a great business to be in because it produces residual income. But there's a ton of them. To name a few is Melaleuca. Melaleuca is a wellness company. You can get residual income. Legal Shield, another legal company, residual income. I have a company called Power Solar, produces residual income. So in order to get income, which Stephanie said, you don't have to work for, you build a team and it starts paying you without you actually going out and working. That's an excellent way in order for you to create more income for yourself, to help invest in some of these vehicles that Stephanie's talking about. So I just kind of want to put that on the table as well. Stephanie, Tony Galloway would like to know, are CDs a good way to grow your money?
Yes, there's safe ways, but then there's better ways. That's all. And that's what that whole financial needs analysis is about, is are there, are there better ways to do what it is that you're trying to accomplish? Is there a way to get it done faster? What are we trying to do with a CD? Is it possible that that's something that can be improved upon? And the answer is emphatically yes. The answer is emphatically yes. Meaning that, let me give you an example. Some people save their money under the mattress. So by default, they're missing out on what's called purchasing power by default, because they're saving it. It's safe up under the mattress or sitting in a safe in a house. But by default, it's losing purchasing power because inflation averages usually, it had been averaging, 3 to 4%. Now we're in this year was like 7%. So what that means is for every $1 that you have sitting in a mattress or sitting in the bank that's not getting you a good rate of return, you're actually losing money by sitting in there. Now, is it safe? Can you go get it? Yeah, absolutely. But can it be safer someplace else and make you more money? Yes, absolutely can. And so just give me a call on that. And then, because we have all of those vehicles where we're actually able to help, folks to be able to make money. And that's the goal. You want to have, one of the things that you guys have to understand, Many of us are not born with a silver spoon, especially when we talk about what do the Rockefellers do. Many of us are not born with a silver spoon in our mouth or anything like that. So oftentimes we have to get up and go to work for our money. But there will come a time when you cannot go to work for your money. You will need to have your money working for you. So what you always want to do is when you come to something like this, you want to begin with Michael or myself. How can I put my money to work for me so that when I can no longer go to work and then my money is still working for me? What do I mean by that? You ever seen a dollar bill call in sick? You ever seen a dollar bill say, I got arthritis? You ever seen a dollar bill catch a cold? You ever seen a dollar bill catch COVID? And can't get up and go to work for 3 months. Have you ever seen the dollar bill laid up in the hospital because it got into a car wreck or an accident? Or got burnt on the kitchen stove or something like that. You never seen a dollar bill experience any of those situations. When you put it in the right place, it just works and works and works and works and works for you. While you may experience catching a cold, car accident, COVID, getting burned on the kitchen stove or something or another like that, arthritis, cancer, while you may experience different things, that dollar bill is not experiencing that. So you want to make sure it's working for you while you're doing your thing, because there will come a time for all of us. There'll come a time for all of us where we may not physically be able to get up and go to work for our money. But yet and still, we need to have our money work for us. The one scripture that Michael, not trying to get preachy, but just comes to mind, I must work the works of him that sent me while it is day, because night will come when no man can work. So not only do I need to do some stuff and get disciplined, like what you said, Michael, about it, I need to be disciplined about it. But then I need to also make sure that my money is disciplined and making some money on top of that money so that it can do its thing as well. And then that will be able to help take care of me, perhaps when I can't take care of myself. That's how that works out. Okay.
Excellent. All right, Dolores Thomas, she has her hand up. Dolores, can you come off of mute, please, and ask your question?
Yes, sir. I'm really enjoying this class. Two questions. I'm in the process of trying to get my real estate license. Is it good to get the real estate and the brokers at the same time, so I won't have to, use a broker, And the second question is, I owe like $30,000, maybe 32 on a house. So what is the quickest way that I can just get rid of that? That's it.
Okay, Dolores, if you can, put your telephone number in the chat to me directly, if you can.
Okay.
I'd like to answer the real estate question offline. But
okay.
The second question is excellent, so I'm going to turn that one over to Stephanie.
Oh, actually, I was going to turn that one over to you, Michael.
Well, I'm turning it back over to you. Give her some wisdom.
Well, so if I heard you correctly, the second question is, is whether or not you should just go ahead and, pay off the home at $32,000. Is that the question?
Correct.
Okay. There's a couple of schools of thought on that. By and large, to be able to make an overall recommendation normally requires for me to see a person's whole portfolio. The reason why I say that is because if there's a couple of things in place, if we don't have enough reserves, if we don't have enough emergency funds, if something, crops up, then we would have given our dollars perhaps away, when, just one short emergency, we may be needing those dollars, or, it could be a situation where if I have, do I have a vehicle? Do I have a vehicle already in place? And this is the reason why I say, doing a whole financial needs analysis. Do I have a vehicle in place where I can pull that 32,000, gain complete ownership of my property, but then also potentially to pay myself back with interest, using that rule of 72, power of compound interest, so that my money can be making more money on top of that, or just pay myself back so that, again, either on a payment plan or as a lump sum, and so, again, again, that's the reason why we offer up the complimentary financial needs analysis, because, you know, there's a couple of ways to actually do it. The question is what's right for you? And an excellent question. I think that brings up, you guys, one other thing that I wanted to mention. When we talk about different vehicles in place, checking accounts, saving accounts, CDs, mutual funds, stocks, bonds, treasuries, 401ks, 403bs, 457 plan, your TSP plan, your Horizons, your Roth IRAs, your IULs, VULs, municipal bonds. What you need to understand, every last one of those products were created for a reason. They serve the purpose. They serve the purpose for something and someone. The question that the reason why we put ourselves out there and give you the complimentary financial needs analysis is, which one is best for you? Which one is suitable for you? I use this example all the time, Michael. 1-bedroom house. I've seen it, and I've shown it. 1-bedroom house is not good for most people, but it's perfect for the right individual. For the right individual, that 1-bedroom house is perfect. But for most individuals, it will not suffice. But it was built for a reason. There's a reason why it was built. So you guys, when it comes to financial services, this is the reason why we just don't like to willy-nilly just, try to solve, questions, because again, a more prudent advisor, one that's fairly responsible, they're going to want to see the whole, your whole situation, basically to be able to give you the best advice, because you should want the best advice. But by and large, I wholeheartedly believe in ownership. I believe folks need to own, so you want to own your financial service products. You want to own your home, your vehicles. You want to own your auto vehicles without, payments and everything. You want to own everything and be payment free if you're in a position to do that. If you're not in a position to do that, let's work towards that. It's what you want to do. It's how that works out. So hopefully, I know I probably took the long way around that, but there's two schools of thought. Yes, pay it off, get it done with, but another school of thought is, do I have a vehicle, where I can leverage, and overall, if I paid it off, is that going to put me in a bind? Because the last thing we want to do is put people in a financial bind, because things are happening, you're going to need your ducats. Things are happening, so you're going to need your money. Okay, back to you, Mike.
Excellent. We have about 3 minutes left. So we have one other question, then we have a comment. So Tony would like to know, which financial institution is best to use, a bank or a credit union? Which financial institution is best to use, a bank or credit union? And she's talking about the CDs.
Okay. Well, it actually still does depend. If you're looking to get growth on it, whichever one is going to give you, the best amount of growth. But then also between the banks and the credit union, then you also have to kind of look at the fees as well, because banks make their money off of the fees, and so, so that's one of the things that you actually want to, take into consideration, but by and large, you'll be going with whichever institution typically has less fees, and that's usually the credit union has less fees than the banks.
Awesome.
But if you're looking to be able to, get great rate of return, you definitely need to call me, Tony, because there's other vehicles that can get you a much better rate of return on your money and keep it just as safe, if not safer, just as safe, if not safer than the bank. What do I mean by that? There's a reason why they got that little sign up there that says only $250,000 in deposits are FDIC insured. So.
Awesome. Okay, we got 2 more minutes. Mr. Mark Jones, I believe, has raised his hands. Mark, would you like to unmute?
Thank you very much, Michael, and thank you very much, Sister Hicks. I came to the training today late, and I apologize for that. I'm a pastor, and I had another obligation I couldn't avoid. But I asked a question you may have already answered, and you almost did again by listing all of the resources that we might have at our disposal. But if you, as I think it was Tony said, come to the game late, what are some of the sources of these sources? that we can use to invest?
Well, I did probably kind of answer that one with Tony's situation. And I was saying for Tony, 18 to 80. I mean, it's not too late. It's just not too late. The thing of it is that what's going to be the right vehicle. And then on top of that, you guys, we have several different companies. So there may be a product, but it might be better to get that product from company A rather than get that same product from company B. See, that's how, so by and large, what we do is we customize, Mark. We're going to customize it for you to make sure that it's suitable for you, because I can put, as a matter of fact, I have a set of clients that are twins. Both of them married, both of them don't have the same number of children, anything like that. But coming up, when they were coming up and everything was the same. However, life started diverging, and what I would normally recommend for one twin is not the same thing that the other twins, and it doesn't really get too, it doesn't really get, too much divisive than you having a set of twins that both think alike, talk alike, finish each other's sentences. You were thinking that, everything would be the same, but no, this one twin, I have to put them in this particular situation, but the other twin, I have to put in that situation. Okay, but me putting them off into those vehicles still allow both of them to be able to reach their goal. So hopefully that makes sense to you. Mark, it's not too late, but we customize, you guys, and that's the reason why my contact information is down there. I am old school. I do have a Gmail account, but if you really want to get a hold of me, do that AOL, because I've been licensed in the industry for a long, long time. My clients can find me. They don't have to, good markets, bad markets. I'm not ducking or dodging anybody. Okay. So that information is down there. If you're trying to get a hold of me by phone, leave me a voicemail, then text me, and then I'll be sure to reach out, Instagram page, SV Hicks 1913. And then my company page, tfaconnects.com/Stephanie Hicks is how that works out. Contact me, but by and large, shoot me a text and let's set up a time. Let's set up a time to meet. We can actually help you be able to, customize something specifically for your situation to make sure that you're on target for what you're trying to do. Because what I might recommend for Tony would be different than what it is I would recommend for you. And the company I would take Tony through may be a completely different company than I would take you through. But nevertheless, it would help Tony reach her goal, and it would also help you to reach your goal. And both of you guys are going to be happy campers as a result of it, because that's what we do. Okay, is how that works out. And of course, if anyone is interested in getting into the industry, you guys, we're short staffed. We need about 200,000 folks. So I'm gonna put that plea out there. If you know somebody, over 18, they only just need to be over 18. They don't even need to be young. They can be young, middle age, whatever. But man, we're looking to train. We have a 30-day training program, and we're able to actually get people reimbursed, for some of their training and stuff like that. But the two top industries, real estate, and financial services and everything. Want to get them off into the industry part-time, full-time, get them going off into the training program, and then position them to make additional income, but then learn how to do what the Rockefellers did so that they can make that income work for them, not just for their lifetime, but biblically it says, you guys, a wise man leaves an inheritance for his children's children. And that's one of the things that we actually want to be able to help you guys be able to do. Okay. Right, Michael, back to you.
Stephanie, thank you so very much. This has
Welcome,
been
sir.
Awesome. It's been a pleasure. Once again, everyone here will get a copy of this recording. Everyone here will get their certificate for your vacation, your Las Vegas vacation stay of 3 nights, 4 days. Take advantage of it. It's time to travel. It's time to get out. And we appreciate and we love you and we bless you for being here. And please call Stephanie, chat it up with her, ask questions. She's a world of knowledge, and we'll go there. But until then, hey, have a great Saturday. We appreciate you being here, and we look forward to next Saturday. We're gonna have another powerhouse and he's going to bring even more information. So thank you so much. Thank you, Stephanie. You're awesome.
You're welcome. All
Talk to
right.
you soon.
Thanks, Mike.
Bye-bye.
Everyone, you guys have a good afternoon.